Hello, everyone, and welcome to KJH Insights, our monthly podcast. I am Sarah Bull, partner and portfolio manager at KJH Investors. Thank you for joining us today on our podcast, where we provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. I have Joel Clark, CEO of KJ Harrison, joining me today. It's great to be together again, Joel. Welcome.
Yeah. Hey, Sarah.
So, Joel, we are closing in on the end of February, and since our January podcast, a lot has changed. We talked on that podcast about the implications of Trump 2.0, but since then, things have heated up on the tariff side. Earnings reports have been coming in, and they've been coming in quite healthy. Bond yields have ticked up, which generally shows that the bond market is worried about inflationary pressures. But having said all of that, the S&P continues to show strength in here and as being quite resilient. Can you help us make sense of all of that information?
Sure. So you're right. The rhetoric has been strong, but ironically, the market is at an all-time high. And so why is that? Well, number one, the US economy, the largest economy in the world, is doing well. Growth and inflation are reaccelerating. The job market is strong. Unemployment rate is low. Corporations, you mentioned, we're through probably 75% of earnings season has been, EPS growing anywhere between 8 to 15%. And corporate fundamentals are strong, which is leading to a strong market. So despite all the nervousness of Trump and tariffs and geopolitical risks, the market is ignoring that at the moment. And so, which I think is a bit of a surprise to many.
Yeah, I think that's right. Now, help us understand this, why the market is being so resilient. So you talked about earnings growth, you talked about the economy doing well, general economic, stats there. But what's also changing in the market? Has the market leadership changed in here with the tech stocks?
Yeah, if the last 2 years you had the largest divergence between the S&P, which is a market cap weighted index, and the S&P equal weight, which is giving all the constituents the same weighting. This year, the year-to-date results are the same. So you don't have that level of divergence that you've had the last 2 years where it's only been 7 stocks. You have a bit more of a broadening out, which is healthy. And I think that reflects the fact that, the economy is solid. Interest rates are breaking out, which generally puts pressure on smaller mid-cap companies because they have leverage. The productivity gains through AI and technological progress is having positive implications. So listen, I think at the moment, things seem fairly resilient. And remember, putting tariffs aside, Trump wants lower corporate taxes and deregulation. And Druckenmiller said something a few weeks ago, that Stan Druckenmiller, one of the most renowned investors, that in all his conversations with CEOs, the number one issue on their minds is regulation and red tape. And so that goes a long way to getting M&A going, IPOs going, animal spirits going. If CEOs have a pathway that they can trust, they can invest money. And it seems that Trump certainly wants the U.S. economy to be strong. His number one scorecard, by the way, is the market and the economy. So as much as he might say something to cause a bit of short-term volatility, it can't last too long because he rules his life by what the stock market says.
Yeah, I would agree with that. I think even though this new administration is super unpredictable, I think that's the one thing that's certain about it is they view the direction of the stock market as a real report card. Is that fair to say?
Exactly.
Okay, so just go back though to some of the Fed policy. I think that's interesting in what you said about just the hopes of deregulation under the Trump administration creating optimism. But on the other side, the tariffs are really causing a lot of stress, especially as it relates to Canada. And, there's lots of scenarios under the tariffs in terms of what it might do to the Canadian dollar, what it'll do to sectors across our country. Talk about how the investment team is thinking about that, managing that risk and preparing for it. Because as we always say, you can't predict, so you have to prepare.
Yeah, so it's very challenging to predict how this is going to play out because I don't even think Trump knows. He came out on a Monday morning with tariffs, and by lunchtime, the rumor was he was reversing them. So it's very challenging to make any concrete changes. And so when you're in that type of environment, you have to rely on just owning the best businesses and counting on those management teams and those businesses doing what they do best. And so what we're really talking about are things at the margins. So number one, obviously the Canadian economy would suffer under a heavy tariff load. So we're predominantly at the moment US centric investment holdings. So there's just obvious things that you avoid in your security selection, those companies that might go under pressure. So you keep that in mind. In the technology world, part of the reason why the market is I don't think it's ignoring it, but it's Apple and Amazon, and these are debt-free, large free cash flowing companies that it's not like steel going back and forth across a border. So the makeup of the market and the indices really matters. And so you just have to, in your investment process, which is just avoid those things that you think are at risk of negative impact, like you said, from tariffs. And then maybe they overly discount it and you can take advantage of them because they've been unduly punished. So lots of risk management, lots of opportunistic investing. You just have to keep focused, discipline, not whipping the portfolio around based on headlines. We own great companies run by great management teams, and you let them compound and navigate these challenges themselves.
I think the investment team had a really good point at our annual investor meeting about the Canadian equities that we own, that many of them do not have economic sensitivity in terms of exposure to tariffs because they're almost accidentally Canadian in the sense that they have so many international revenues. Can you just maybe elaborate on how the investment team is thinking that way too when they're looking at Canadian equities?
Yeah, and you can own Canada's fairly commodity centric, and there's a lot of equities that if you do put tariffs on certain commodities, obviously the price then goes up, which benefits some of these producers. So it's not to say that everyone suffers equally under a tariff regime. So there's some companies that benefit, some that don't. You can redirect where you send commodities. I mean, we operate in a very global world. There's lots of demand from China or Europe or what have you. So in the short term, there might be some pain, but over time we'll tell. And you saw Walmart, come forth with earnings yesterday talking about the potential weakness from those countries that they operate in where tariffs might be the case. So it's security by security. You can't sort of paint a blanket picture across the entire Canadian stock market, that's for sure.
And I guess one scenario could be if tariffs are applied against Canada, the government would just increase economic and fiscal stimulus to help those companies that are affected.
Yeah, they're definitely looking at that, that's for sure. Depends how much lower interest rates go, but you're right. There's things that governments can do to countermeasure tariffs.
Let's move over to fixed income markets and strategies. How are we thinking about credit right now?
Let's just start with rates. They haven't really done much. The 10-year US T-bond is, call it 4.5%, which is in that sort of sweet spot. It's not worried about roaring inflation, neither is it worrying about deflation. Credit spreads are at the tighter end again, so not worried about the economy falling apart, but the problem with that is fairly overvalued. So, my expectation, credit has a pretty good year. Can't really count on credit spreads narrowing much to give you some appreciation. It's really just sort of coupon clipping. It's going to be a coupon clipping year for sure.
And do you think the Fed continues to just tolerate inflation levels at where they are now without immediate action?
Yeah, I think the markets definitely has eliminated its expectation of material cuts in the US. I think it's discounting maybe 1 to 1.5 cuts this year. So that's pretty much out of the market.
So, given that we always talk about an all weather portfolio and really helping our clients generate the highest risk adjusted rates of return, well, how are we thinking about optimal allocation for the year ahead?
Yeah, I think that's probably the most important point, especially when you have a chaotic environment. Having a well diversified portfolio across credit and equities and best in class businesses across various industry is probably the best approach. It's too much of a challenging environment to make one call and concentrate on that call. So I think this will definitely be a year where managing money in balance will produce the optimal outcome, both from a return and a risk management basis.
Yeah, and I think, as you just said, it's when there's so much uncertainty, you have to make sure that you're diversified across large cap, mid cap, tech, other sectors, as well as asset classes.
You got it.
Great. So, Joel, I feel that we're coming to the end of our time together for this month's podcast. Is there anything else that's on your mind and on the mind of the investment team that you want to share with our listeners?
I think, the last 2 months is a really good sort of lesson because there was so much anxiety and really nothing's happened. And the economy's strong, markets are reflecting that. Hopefully, cooler heads always prevail. Who knows? But we've certainly got through the first 60 or so days in pretty good shape. So I think the point I just made about just keeping diversified, disciplined, owning good companies across credit and equities will win the day this year for sure.
Yeah, and I think the point you made that for long term investors, volatility can actually drive some great returns as long as people stay patient.
Yeah, and of course, to make money, you do need volatility. If everything just becomes overvalued and there's no volatility, it's hard to drive returns, and then you're forced to sort of reach for returns, which always ends badly. So don't mind a bit of volatility because with that comes opportunity. But at the moment, it's been a pretty benign start to the year, despite sort of expectations.
This is a good place to wrap up then, because I think our goal with this podcast is to cut through the noise and really focus on what matters and how the investment team is thinking about the market and cutting through the blustering, so to speak, and what's real. And that's what impacts our investment decisions. So I think on that note, we will end here. So thank you very much to our listeners for joining in today. We'll be back next month with another issue of our KJH Insights podcast. So wishing everyone a good snowy or maybe not so snowy March. And as a reminder, if you have any questions about your portfolio, please reach out to anyone on the investment team or private client team. And we'll continue to provide you with commentaries and updates as the market and the market narrative unfolds. All of those are available on our website at kjharrison.com. So have a good spring, and we look forward to speaking to you next month.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.